Welcome to the dark side of TikTok, where we learn about creepy things like shorting stocks, which we should not be learning about, but it's important to understand. Hey everyone, my name is Dan, and normally on this channel, I talk about all things finances to help you guys take control of your own financial situation to get that future that you deserve. But today we're going on a slight tangent from that. We're talking about short selling stocks. The very first thing you need to know about short selling is it is a huge risk and a massive gamble. Effectively, what we're doing is betting against a company, betting against a company's stock price. And it's the opposite of what we normally do when we invest. And that's why it's really counterintuitive and can be a little bit tricky to wrap your head around. Basically, instead of doing what we normally do, which is buy a stock at a low price and try to sell it at a high price, with short selling, we start over here and sell at a high price, and we look to buy back in at a low price. So basically, rather than hoping that a stock will grow in price, we're hoping that it will instead plummet in price. But Dan, how can we sell a stock that we don't even own? Good question, random person through my camera. You are very astute. The way we do it is actually very unusual because, like you suggested, you clever bugger, we don't actually own those stocks. So how do we get hold of that stock? Well, we do it in an obscure way through what is called a margin loan through our broker, which means that we effectively borrow those shares from our broker to pay back to them at a later date. Don't worry if that's confusing. We're going to go over it right now. Let's map it out. If you come to a decision that you think a stock price is going to go down and you want to short your position in that stock, then this is what you would do. You'd go up to your broker, let's call them Joe Blow, and you'd say, Joe, I've got a company I'm interested in and I want to short my position in their stock. Joe will then go find those shares either in their own inventory, or maybe they'll have to go to their client portfolios, or they might even need to go to a third-party broker in order to get these shares for you. Once Joe finds those shares, they're going to come back to you and say, we've found those shares, you can borrow them, but at a fee and with interest rates that you will pay off until you pay me back my initial shares. So pretty much you are borrowing somebody else's shares to make that particular trade and paying them back at a later date. So once you get those borrowed shares, the first thing you do is sell them at the market price because you're hoping they go down. And once they do go down to a level that you're happy with or satisfied with, you will then buy those shares at that price, at that lower price. You will then take those shares, give them back to the broker that you borrowed them from, and you will take the rest in profits. Now, there are 4 very important things to understand about short selling stocks, some big cons, and the 4th one is by far the most important. The first is something that we've already spoken about. You will owe fees and interest to the person who you borrowed the shares from. The second thing to understand is with traditional investing, we receive dividends for the life of our investment, barring some different situations, but generally you receive dividends on your investment. But when you short stocks, it's the exact opposite. You actually pay those dividends back to the person who you borrow the shares from because after all, they're not your shares, you're just borrowing them. The third con is in order to make these short transactions, you actually need a margin account, which is not ideal. It's very, very risky because no matter whether the bet goes well or goes bust, you will owe money back to your lender regardless of the situation. That is not your money. Those are not your shares. You will need to pay them back. And that is always a risky thing, especially when you're betting against a company. And the 4th and most important by far is that there is no limit to your losses when shorting a stock. The way we traditionally buy shares, the worst case scenario is that the stock price goes to 0 and you lose your initial investment, which is not ideal. But the worst case scenario when we're shorting stock is that the stock price continues to grow infinitely. There is theoretically no limit to any stock price. So with normal share purchases, we have a capped loss at our initial investment and we have unlimited potential gains. But with short stocks, we have unlimited potential losses as the stock price grows, but we have capped gains because as soon as that stock price hits 0, you can't make any more money on it. So you can see that not only is it a high risk option, it's also a double-edged sword. You're capping your gains and unlimiting your losses rather than capping your losses and unlimiting your gains. And that's why it's pretty uncommon to see the average retail investor short stocks. It's usually something that you see in hedge funds and big corporations. It's just too risky for the average person like you and me to take on. So I hope that clears it up for you guys. I know this is a really trippy concept to get your head around. It's definitely counterintuitive. It goes against everything that we learn and everything we understand about the market, But it's a concept that's at least good to understand, especially because it comes up in life here and there. Guys, if you enjoyed the video, do me a favor, hit the thumbs up. It helps me grow this channel like you couldn't imagine. And if you want to see more from me, make sure you subscribe and turn on the bell notifications. I'll see you next time. See ya!